All right, hello everybody. I hope everybody's well. Please, can you guys hear me? I hope so. Give me a sign that you can. Perfect. All right, guys. Well, welcome. It's a free webinar. Typically, they've been premiums for a while, so it's nice to be chatting to everybody. And it's the same rules as always. If you have a question, fire away. Let's have a conversation. If you feel like you stop me, we cover it in more detail. And was open. I wanted to keep it quite light. The world is so serious at the moment that it's tough to keep perspective, and that's why I thought that maybe we could have a webinar that talks about exactly that. And what's interesting about this period now is, first of all, let's do a 2-minute recap. I think it was January. We did a webinar and we talked about the potential for this being a bit of a black swan situation. And I almost presented that webinar tongue-in-cheek that this was some wild hypothetical. I don't know how many of you attended that. And we talked about pretty much everything. The only thing that we didn't talk about was the fact that oil was going to tank on its face and lose 50% of its value in a month. We kind of talked about oil to 20, but the shock in the system was too much there. And as a result, all that emerging market stuff just got roasted on the currency side. But we'll recap that too. That's a bit of a bitter story, a bit of a tale of woe. But anyway, let's get right down to it. So there's a couple of ways to mitigate risk in crazy markets. All right. And one is trade smaller, and we almost have no choice to do that because I don't know about you, but margins have just gone crazy. You know, yeah, and it's no big deal here for it to be a $4,000 standard lot for a pound trade. Ridiculous. But that's where we are, and there's nothing we can do with that. The most important thing that I can say on a risk management side of things is patience. It's the one asset we do have. All right. And I want to speak to patience a little bit. And the discussion today was how to stay calm under fire. So it's about the process more than it is anything. You know, at other times when volatility is low, you can get away with being a little more flexible, particularly around entry and exit, and you're not going to get quite as penalized. I mean, don't get me wrong, you're going to get hurt, but you're not going to get quite as penalized as much as you do here. All right. So like I said, please fire away with questions. It's the only way that I know that you engaged or with me or enjoying the webinar at all. So I wanted to bring up a couple of things. One is that let's talk about demand, all right, and the mechanism for demand, because I sort of have a thesis, particularly on the dollar, is when we're in a situation where, we're seeing a deflationary market, which is what we are, asset prices dropping, and where we're seeing a dovish Fed, asset prices dropping, it's deflationary, growing, or growth is obviously slowing to minus levels. This is the only phase in which the dollar strengthens. All right, when we probably going to go from here into a stagflationary phase of also slowing growth, monetary policy turns to neutral, all right, and the market narrative sort of heads towards a stagflationary side of things. All right. The difference there is that we're likely to see some dollar weakness. Okay, so in this particular time, there's a couple of things that work on the short side. Tech, energy, industrials, financials, the dollar, the stock market, gold typically goes up, oil drops, all right? And then on the fixed income side, I'm not sure. We can get into that, but that's a little more intricate than maybe you guys bargained for. So our thesis is short stock market, long dollar, long gold, short energy. All right? That's just how these deflationary periods work. Every other phase of the economy, the dollar weakens, which is quite handy to know. So if you're talking about accelerating growth, monetary policy neutral, and everybody's happy, volatility is very, very low, you talk about dollar weakness. Or if you're talking about periods of accelerated growth, accelerating inflation, hawkish Fed, and the market narrative is all about reflation, dollar weakens. So the only period from a fundamental basis in which the dollar strengthens is during these moments, all right, of slowing growth, deflating or inflation decelerating, dovish Fed, and the whole market narrative is deflation. All right, now, there's another very sort of key thing I want to touch on here, and I'm going to borrow from Hedgeye here, which is a macro subscription I pay for, and I want to show you this. Okay, this is, and this roots back to what the point of this webinar was that under fire, you've got to be very clear about your process. And for me, it's get long the dollar, get long metals, not copper, obviously, and get short the stock market. That's all I'm trying to do in these moments. All right. Now, we just saw 3 weeks ago unemployment claims 700,000. The week prior to that, 3.2 million. And this last week, 6.2 million. That's 11 million jobs in 3 weeks. And this cycle started, if you actually think about it, we actually finished a whole credit cycle, a whole earnings cycle, and an entire equity cycle way back in Q4 of 2018. And then last year, we kind of had this stagflationary or reflationary push to the upside as the Fed stimulated at all-time employment levels. Now, and you'll see this over in history. And I know a lot of you get bored by get a little bit bored by the fundamentals, but this is important stuff. If you see things, you'll see stuff like this, that during I don't have the graphic up, unfortunately, but what I mean by an entire earnings cycle is in the S&P between minus 13 to 16% of all S&P assets at the bottom of the cycle, 13 to 16% are negative earnings, positive growth businesses. The Ubers of the world, meaning that 13% of the S&P are making negative earnings within the context of an upside stock market. All right? And you'll see these cycles every 7 to 10 years. And that's just a good barometer for the top side of the stock market. And it's the same sort of thing if you're using something like the CAPE ratio, which is what Buffett talks about a lot. All right, that's price earnings ratio based on average inflation, adjusted earnings for the last 10 years. And I can pull that chart up. You'll see a mean there too for winner markets, overbought and oversold. In contrary terms, at the bottom of a market, you'll see between 50 and 60% of companies with negative earnings of the S&P. In other words, more than half are losing money. we're at the bottom of the cycle that's close to 13 to 16%. This is why it kills me when, when friends go to their financial advisor and say, and they put them in the stock market at the top. I mean, we just know this stuff. These are standards that have been there for 100 years, literally. You know, and we look at something like market cap to GDP. Well, in 2003, it was 140% of GDP. And these are things that we've talked about at length in our webinars. Okay. This was essentially the sort of correction of, well, 2020, we were at 140%. And now we're at around 113%. Well, the median over the last 100 years is 70%. So at 113, we are still very, very bubbly. Very. Okay? And to my point, the reason why I'm taking you through this is we cannot divert from the bias. The bias of what you're doing here is everything. Because once you have a bias, then it's a matter of committing to the top side of your ranges to sell, or the bottom side of your ranges to book gains, or the bottom side of your ranges and things like gold and treasuries to buy. Okay? So this is why I'm going through this, is because there's going to be a lot of noise in your ear and you don't want to be diverted yet. When the bottom's in, we'll talk about the bottom being in, and it'll be proven out through data. It won't be an opinion. It won't be somebody coming on CNBC and telling you, oh, there's less cases in Spain. There's less cases in France. There's less cases in Italy. There's less cases in New York. It's time to be bullish. No. There's no exit strategy to that, by the way. All right. And I fully expect that we're going to see a minus 20 to 30% GDP number come out in 2 weeks' time. Well, the last time that happened was 1929. And look at the duration that it took for us to recover from that. 44 months. The very shortest recession, and we're talking minus 2%, was here in the 80s. That took 7 months. Well, we are 3 into it, more like 2 months into it. Okay? So let's not get diverted from what's going on here. Okay? We are in a deflationary period with slowing growth. That means dollar up, S&P down, gold up, and probably Bitcoin here, for those of you that are into that. Bitcoin's a little bit like a, you know, like an option on a future market. That might be an interesting webinar for the next time, as to what does the world look like when this is all over? Because remember, our job is to look into the distance, not in the rearview mirror. But I wanted to show you this so that you can block out the noise. You're going to get a lot of the media, and I have a very good friend who works for Morgan Stanley in Beverly Hills. Very smart, very talented, very bullish. Because that's what they do. They're paid to buy stocks. All right, but none of this has come into it. You know, if we do an 18 print, there was a 14-month recovery there. And I'm thinking that we're going to be closer to depressionary data here. But David, when we come out of lockdown, everybody will just go back to work. Let's think about that. If you are Adam LLC, Adam, I just picked your name out the hat because it's at the top of the list. If you are Adam LLC and you making, I don't know, baseball bats, or Little League Baseball around the world. All right. And you had a business that employed 100 people. And growth started to slow. Credit started to bind up. And the virus hits. You lay off 60 people. 60 people go and file unemployment, etc. Right. After 6 months, you go back to business kind of as usual, but not quite as usual because there's been a lot of people unemployed, so spending habits are down. And oh, by the way, we have a demographic issue here in the United States that cannot be understated from a consumption standpoint. All right? But when you go back to work or the recession starts to end, do you pick up the phone and call all 60 people back? No, you don't. You try to make the business work with 40. And people being people, you innovate, you learn to live with less. And so maybe you hire 5 back and you try to do business with 45 people. And as things recover, you might hire 10 back. But you're not going to pick up the phone and hire 60 of them back. Just not going to happen. So don't sit there and think, hey, this is a V bottom and I need to be on the long train. No. These things take time. They're a process. And we haven't even seen, to give you some idea, we haven't even seen yet. I'm just pulling up the data in the background here. We haven't really seen the deleveraging in the tech stuff. Remember, in a downturn, the first thing you try to sell is the stuff that hasn't been working. That's the first stuff out the window. Okay? Then, when the you know what hits the fan, you sell what you can. That's why gold tanked for about 3 weeks, is because people will sell what they can, not necessarily what they want to. All right. So if you have a whole bunch of high yield junk debt, there's no bid at any price for that stuff. So you start selling the things you can to cover margin. Gold is very liquid. Notice how it's rebound quicker than anything else because it's something that's working. The other thing you sell very last are the stuff that you've had longest. Microsoft and Apple are the longest held, highest, or by percentage, the highest held stocks of any funds in the world. And people have owned those 10 years. They haven't felt that pain yet. So we're going to see a deleveraging out of those markets too, which still means more dollar strength. And if you remember the last time we talked about, we were sitting at, 108 for the euro. And we said, okay, we're going to do 114 and then we're going to go all the way down towards parity. We're in that dollar strength time right now. Okay, so the point to me telling you all of this for 20 minutes is that our bias needs to remain true until the data changes. All right, you don't need to do any guesswork here. So the stock market's rising today, fine. All right, so if our bias is short, let's look at the S&Ps, we'll build a plan. All right, and then we'll look at the euro, we'll build a plan, and we'll do the same with the pound. Okay, but for simplification, and this is the point of this webinar, we want to develop our bias on a macro fundamental basis. We've done that. Now we're going to look at, I think 1700 is very possible for gold. In fact, I anticipate it. We can look at the range for that too. I have, 1687 possible for today even. All right. And remember, if you're not studying volatility or the volatility of volatility, and I'm talking across all different asset classes to include gold. If you look at GVC for gold, you get the volatility of gold. Well, if you're into golf, volatility is, if we look at the VIX, for example, 10 to 15 is investable territory. If you're looking at 15 or rather 16 to 31, now you're talking about a higher volatility but still investable environment. 31 to 50, bear market. 50 to 85 or 80 to 90, wherever we were, that is the, oh dear, this is seriously bearish. The confirmation that you're in a crash right now is the fact that we're seeing up days of 4 or 5%. You don't see those in a bull market. And if there's one thing I can tell you today, you'll know you're in a bull market or at the start of the bottom because nobody cares. That's when you know you're there. When volatility drops back down to 20 and you start getting like bounces of 0.5%, 1.5%, 2%, 1%. That's when you know volatility's come right off back into an investable level and your CAPE ratios are back towards 15. Your market cap to GDP is closer to 70, not 140. And your profitable companies as a percentage of the GDP, as a percentage of the S&P is say 60% not profitable, meaning that they're losing money. That's when you know you're at the top of the cycle, or the bottom of the cycle rather. Okay? We've got time is what I'm saying to you. All right, so how to day trade the Euro USD. We're going to talk about all of that. I've got a couple of questions there about the pound and the euro, and we're going to bang out some plans in the next 20 minutes. Okay? So let's get with it. Our S&Ps, and I like to think about these things in ranges. All right, so I use pivots for that. There's other ways of doing this, but I also, it's a product of the volatility of volatility. All right, and for me, I had the top side of my range today for the pound as, for the S&Ps as 2660 and the bottom as 2303. And that's based on the VIX potentially getting down to 42. All right. So if we're starting the day somewhere around 2560 and the top of my range is, 2660, I actually think it's closer to 2680 to 2720. Okay, and 2720, and the bottom side of that range is closer to 2300. Okay, if we start in the day at 2550 odd, a little bit higher than that, we're right in the middle. That's not an extreme to that range. Okay, so you can calculate these ranges a couple of different ways. You can use pivots, which is my preference. Here's the weekly S&P here. And the top side of that is in that 2670, 2730 range, and the bottom side is right around that 2310. So when you're floating around that 25, you're in the middle of nowhere. You're talking about, that's an interesting question. So the question is, what do I think of the dollar as the global reserve currency, and will it lose its role, and is it smart to hold a whole bunch of Chinese yuan? Let me get through this S&P and I'll answer that because it's an interesting question and I have an idea for that. And it's not an easy thing to answer. And I think we're going to go to sort of a pseudo basket of dollar denominated or rather mixed currencies. But we'll talk about, let me get through this and we'll talk about that. Okay. Here's a weekly S&P. And if we zoom way out, go to the monthly, I think that we're still on track or something like this, where we push down into this range. That's the 50% at 2029 and the 618 at 17 change. So I think it's very feasible for us to print 1850, 1950 as a goal. Okay. And if I just flash to the DAX very quickly, I want to show you this because I've been using the DAX a lot for reference as far as support, because here we had this 2008 high, or 2006 rather, and then the 2008 high, not much above that, and this very obvious trend line, and we hit it flush and stuck. So if this was an hourly chart, you would expect that we made a fib of that whole drop based on that. Well, the 382 is all that there 10.1, and this previous low is up there 10.350. So I thought that that would at least give us a drop that took us to the back down to the bottom of this range, which is all the way down at 8,900. So if that's the case, we had a little more upside of the DAX to go to get into the meat of that. I got my little red splodge a little lower there, but I'm going to raise it up based on. So we have more to go. So on a correlated basis, we probably have more room on the S&P. So if I go back here, to answer your question, I think that both the Hong Kong dollar and the Chinese yuan are going to depeg from the dollar. They are debt machines. You know, Chinese banks have 300% of Chinese GDP in negative yielding debt. I mean, crazy debt numbers. I fully expect that the Chinese yuan will actually depeg to the dollar along with the Hong Kong dollar completely, just because of their debt burden. I would not own a ton of Chinese currency. No. Kind of bearish on the markets, to be fair. Anyway, getting back to this S&P plan. So the top of our range we said was 2670 to 2731. And then the bottom of our range was 23. And we're sitting right in the middle. So that's do nothing territory where it is. And when we get here, we can either take shorts or we can buy puts for the bottom of the range, which is really how the big money is made. And, you know, I think we're looking at something like that. And then instead of a cup and handle, push down. So the whole point to this, to reiterate, is bias, and then wait for the top of your extreme ranges, and then trade at those ranges. Nothing in between. Does that make sense? And those ranges are made of pivots, fibs, other technical indicators, support and resistance. Don't get caught being in the middle. Now, I fully expect on an intraday basis, we're going to, you know, on an intraday basis, yeah, the S&P will probably, you know, we're coming off this. We're probably going to come all the way down here to 25, 30, and then mess around, and then all the way up. And yeah, there's trading in between there. If that's your jam, knock yourself out. It's not mine. To me, this is the extreme end of the range. And this is the bottom end of that particular range. And in a more broader sense, this is my risk. You know, something like that. as opposed to something like this. And then this is my reward here, as opposed to something like that. And if you are right 50% of the time or more, you know, you need this risk reward to mitigate your risk. That's it. I hope that makes sense. So the point is here, erase the opinions you hear all over the place. Follow the data, follow the extreme end of your range as a process. And there's another interesting moniker that I've always stuck by. If you cannot tell somebody what your process is, you don't have one. Something to think about. If a friend comes up to you and says, what are you doing with that whole trading thing? Well, I use a macro thesis to develop a bias, and then I use volatility and other technical indicators on a fractal basis to work out the extreme ends of a range, and then trade in the direction of the bias at the extreme edges of the ranges, and I mitigate my risk that way and maximize my profit. Whoa, okay. Well, how are you calculating that bias? Well, I'm using leading and lagging macro indicators from across the world, and then developing a thesis relative to other currencies and the prevailing market conditions, of which there's 4 of them. Done. You have a process, a framework. Okay. So let's talk about the euro. Yeah. And our framework for the euro is dollar strength in a time of deflation. So that's what we're going to look to do, sell it. So 109.05 is this week's weekly central pivot, and 105.34 is the weekly S2. And daily R2, so I'm pulling these, just running numbers out to you. So our sort of weekly range starting below is 109.05, bottom here is more like 105.30, and daily R2 would be 109.04, which is right around that weekly central pivot as well. All right, so in my mind, our range is 400 pips between 109.05 and that 105 area. Tough to do anything here because you are at this previous support, and it would not be unreasonable to see a bounce. In fact, it's expected. Also, if the equity markets are going to bounce here, which we kind of expect from 25.30 all the way up to 27 change, that we're likely to see a little bit of dollar weakness. I do like it. It is a pretty strong confirmation of the dollar strength, given that we have seen a pretty big bounce here over the last, since the market opened from last Friday to the high of 150 points, and the dollar still remained pretty strong. I don't have time to explain the mechanism behind why the dollar is strong during these moments, but we can do that next time. Or you can tweet me and I'll get back to you at ForexDavid, FOREXDAVID. But if we had 109.05 as the spot that we're looking at, does that correspond with anything? Previous high, support, and our pivots. And if we take a measurement of this drop, 109.13 is the 382, 57 is the 50%. So that becomes a little hot zone. David, what happens if it doesn't get to my level? Well, then I don't trade. It's so interesting to me, and I'll just get this out the way quick. We are losing tens of thousands of people across the world. In previous war times, men would go to war and die face down in a bloody mess in a swamp. Other, people that stayed behind would work in sweatshops to make war machines. And that was the way we dealt with it. Today's day and age, we're asking people to just chill at home and watch Netflix and attend FX Street webinars, and we cannot do it. It's unbelievable, isn't it? I mean, it's really unbelievable. And so, if we don't reach the levels we want in trades, why is it so hard to just chill and wait? The money's made in the risk management. That's what I'm saying. Stick to the process. Anyway, so we have a bunch of support here. Our bias is down. I think it's very reasonable that we sort of see something like this and a continuation down here on the euro. We're going to come right back to the bottom, and then we'd like to do the little cup and handle on the downside. So there is one entry, two, and then probably even another hiccup here around 106, another little swing, and then we could short, 1, 2, 3 there. And I think you're looking for parity, maybe even 95 cents. So macro bias coupled into technicals, multiple overlapping areas, patience, discipline, patience, discipline. And then we have a little trade plan in mind, and that's that. So when you're watching CNBC or Bloomberg and all the talking heads are coming on there, understand that the good ones will never talk their book, by the way. In fact, they're probably chasing you to do something the opposite. All right. So, and there's a difference between adding to losers and building a position. If you said, all right, well, in the red zone, I'm going to have a crack at 109, 10, 20, and then another one at the resistance at 109, 80. And then, if it got really up there a bit, 110 and change. And you said to yourself, 3 entries there is 4% of my trading account. And that's it. And if it happens to touch 1 and goes down and you're in there with 1%, well, c'est la vie. So it's okay to build something through a zone, but it has to be through your zone. All right. So the pound, and I am a little more bearish on the euro just because I think euro Oz than the Aussie in this moment, just because I think that the euro Aussie can drop somewhere close to 175. And so that means short-term euro weakness relative to the Aussie, but I'm not an Aussie bull. So I thought if we get short the Aussie somewhere around 62.20 and then trying to take that down to 59 cents, that makes a lot of sense. But it's going to be more because a product of the euro Aussie hitting big time support that'll give the Aussie dollar an opportunity to get weak on a comparative basis, relative basis. All right. Now, let me flip to the euro pound because I wanted to show you this. Now, the dollar, I still remain dollar bullish to include the pound. That's across the board. And you can trade this through something like UUP if you're into the more ETF stuff. You don't have to trade just on the currency things, but we are here for currency. This is an FX webinar. The pound, the pound overshot us here. I mean, you can see where I was wanting to short, and you talk about 400 pips. So this hurt here in between. But I think that we now are establishing this little bit of top, and the dollar really is kicking in again. And the fact that the volatility is still high confirms to me that we're still in this bear market. So I don't have as much downside in mind for the pound as I do, comparatively speaking, for the euro. Let me show you euro pound in a moment. I just think the European markets are in absolute in bad shape. And guys, it bears out. There's been, the COVID, the corona thing, the old C19 or the Rona, as they're calling it here now. Keep in mind that there's no real exit strategy, is there? Until there's a vaccine. And even then, who gets the vaccine first? It's one thing to produce a vaccine, and 31 companies around the world chasing one. But even if they find one, the efficacy of it, we don't really know. The production, it's one thing to come up with a vaccine, it's another thing to test it, and then it's a whole different story to manufacture it. It's not easy. 7.5 billion doses, mind you. Anyway, so I guess my point is that here is, let me show you this because this is interesting. This is 1929. I actually have an updated one right here. So this is the 1929 versus today's crash. And because I'm looking for this as the model, the Great Depression. I'm looking for this as the model just because of the extrapolation of what I think GDP is going to be. And this stretch here is a little bit of a rebound, but we're going to make another jog down, I feel. I think that this market, just looking at it on a technical basis, we see sort of something like this, and then we see this move and the trickle down that lasts a long time. Remember, I said 44 months. All right, and this will be a period of dollar weakness. So you could see, 95 to 98 cents on the euro, and then a rebound all the way back to 110, and then it sells off again. So good trading ahead. But I wanted to show you this because we've got a long way to go. This is over the next 3 years. Yeah. And we are over here. So don't think, don't think that you've missed the boat completely. All right. Now, and that obviously has dollar implications too. Euro pound, we have run into a pretty significant area of support. And it's the same sort of thing for pound Swiss. I think we're going lower ultimately, but it would be reasonable to expect a bounce here. I know I'm at my time, but we'll skedaddle. So I'm kind of thinking something like this on the euro pound. That's a 200 pip bounce. I'm not looking to trade the euro pound specifically, but this does have pound implications for a pound trade plan. So if we're expecting a bounce on the euro pound off that sort of 86 and change level, 86.80, then we expect that the pound is going to be weaker than the euro, at least on the short term. All right. So, instead of building the euro, I still like the downside trade plan we had at 109.10, 109.20. But it also makes sense then that, it's something like a 123.80, 1 to 124.30 pound short will take us down 400 pips. So a little something like this. As that euro pound goes up. All right, and this one we're using support, or support, now becoming a resistance, same sort of thing, and we just looking to take it down to the bottom of the range, which I had at 120.46, which pretty much ties in with that previous support, which is down there a little bit more. But you can see it is a soft area. It wicked down there, but there's a little bit of room there. When I say soft, meaning that, this is a support zone rather than a hard area. And that's a good trade. I think, 2380 to 2420, down 400 pips on the pound. That's good enough for government work as the euro pound found support. So once again, it's trading the extreme edge of the range, watching where you are fundamentally, blocking out the noise, mitigating your risk by waiting for your extreme areas, and hanging out, enjoying the ride. And I'll finish on this note. Things are going to be all right. This too shall pass. There's help available. You just got to reach out. The preservation of capital is key. Remember that, if you wanted to get back to break even on the S&P right now, if you bought stocks at the high, you would have to make back 42% return on investment. So don't lose your money. Message there. Okay. And that's it. And more than anything, life will continue, but stay healthy and don't underestimate this virus would be my message. And I know that a lot of you in Europe have gone through an extremely hard time with this, and my condolences for that. And I think we're about to get the hammer laid to us here in the United States too. It's just, we have a lot of space and a lot of complacency, and it's sort of going to creep its way down, particularly here to the southern United States with business as usual, which blows my mind. All right. So thanks for attending. And, obviously it's a complex time. So if you have any questions, reach me on the twit. All right, guys, good luck with everything, and we'll talk to you soon.